Ever think about just how much power a name can have?
Definitely.
I mean, you think back to 2016 when Warren Buffett, through Berkshire Hathaway, they announced that billion-dollar investment in Apple.
Right, yeah.
Apple stock had been down, and then boom, the next day it jumps up almost 4%.
Wow.
Now that stake, as of today, it's worth hundreds of billions.
Unbelievable.
It's a perfect example, really, of what people call the Buffett effect. When he invests, markets move.
It's crazy.
But here's the thing, and I think this is what's going to be really interesting for you. There are so many valuable lessons buried in his early investments, way before his name carried that kind of market-moving power.
Right. Before he was the Oracle of Omaha.
Exactly. So today, that's what we're digging into. We're unearthing the thinking, the strategies behind 5 of those pivotal early investments that Buffett made.
I like it. Back to the basics.
Forget the billions, the headlines. We're going back to the beginning. Grief Bros. Philadelphia and Reading Coal and Iron Company, we'll just call it P&R.
Much easier.
BC Power, American Express, and, of course, Walt Disney. Think of this deep dive as your shortcut to understanding how a legendary investor's mind works.
Sounds good to me. Where do we start?
Let's start with Grief Bros.
Okay, Grief Bros.
So imagine it's the early 1900s. This company, they're massive.
Okay.
Like the biggest cooperage factory in the world.
Cooperage. Now, remind me what exactly is cooperage again?
It's how they made wooden barrels.
Ah, wooden barrels, right.
Yeah. Not exactly the most, exciting industry that pops into your head today.
Not really, no.
And even back in 1951, this is when a young 21-year-old Warren Buffett, he's working for his dad's firm, and he's pushing them to invest in Grief Bros. Even then, the wooden barrel market, it's shrinking.
Makes sense. If you're thinking ahead, you're probably not thinking about wooden barrels.
Right. So the question right off the bat is this. What in the world did Buffett see in this company? It seems, kind of boring, maybe even a bit of a dying industry.
Yeah, good question. Well, what he saw was what's called a classic net-net situation. Net-net.
Okay.
This is a key concept for understanding those early Buffett investments. It's straight out of his mentor, Ben Graham.
Okay.
So a net-net company, it's trading for less than its net current asset value. In plain English, you take all their easy-to-sell assets, like cash, money people owe them, subtract their short-term debts, and the company's stock market value is actually lower than that number.
So you're basically saying they're worth more dead than alive.
In a way, yeah. It's like if you found a $20 bill selling for $10, you can instantly turn around and make a profit.
I get it. Buy low, sell high, but with entire companies.
Exactly. Buffett later called these cigar butt investments.
Cigar bet.
Yeah, not much left, but hey, you can still get one last puff out of it.
Ah, okay. I see.
And you know what? Grief Bros, they fit that profile perfectly, to a T.
Really?
Oh, yeah. Let's look at the numbers. So their net current asset value, about $20.47 per share. Their tangible book value, that's basically, what you'd get if you sold all their stuff, paid off the debts. That was even higher, almost $40 a share.
Wow.
But guess what the market price was?
What?
$18.25 a share. Way less than those assets are worth. We're talking a 54% discount to the tangible stuff.
It's a huge difference.
Right. So here's the lesson for you. The market can totally miss the value of a company's individual parts. Sometimes those pieces are worth more separately than together.
That's where that margin of safety comes in, right? You always talk about.
Absolutely. And with Grief Bros, it wasn't just cash lying around. We're talking 239 manufacturing plants, 11 offices. They owned a ton of wood inventory.
Which, that generally holds its value.
Exactly. And here's another interesting thing they did back in the 40s. They switched to this accounting method called LIFO, last in, first out.
LIFO.
So imagine you're selling, say, lumber, right, and prices are going up. With LIFO on your books, it looks like you're still selling that older, cheaper wood, even if you've already sold it and bought new, more expensive wood.
Interesting. So it makes them look less profitable, right?
On paper, yeah. And their inventory looks less valuable than it really is. So Buffett, he likely saw even more hidden value in Grief Bros than what was obvious at first glance.
So he wasn't betting on the future of wooden barrels, right? He was betting on the fact that the assets themselves were worth more than the entire company was trading for.
You got it. A pure value play.
But wait, there's a twist, right? Grief Bros didn't just liquidate everything and disappear.
Right. Unlike a lot of those classic cigar butt plays, Grief Inc., they're still around.
No way.
Yeah. Big player in industrial packaging, worth billions today. It makes you think, maybe even in those early days, Buffett had a knack for picking companies that could adapt and change with the times, not just those quick liquidation plays.
It's like he was unconsciously looking for more than just, the assets. He saw something about the business itself.
Yeah, perhaps. It's fascinating to think about.
Okay, so next up we have Philadelphia and Reading Coal and Iron Company,
PNR.
P&R, 1952. Now, this is completely different from Grief Bros. Our sources describe P&R as being, well, basically on life support.
Yikes.
They had a long and complicated history, starting with railroads.
Railroads, okay.
Then they got into coal mining. Vertical integration, it seemed like a good idea at the time. Own the mines, own the trains to transport the coal.
Makes sense.
But then antitrust laws came along, and they had to break up the company. And their specialty, anthracite coal, started facing competition from cheaper options. They even went bankrupt back during the Great Depression. So by 1952, they're really struggling. But Buffett, he starts buying shares around $19 a piece. Then the price drops to $9, and he doubles down. Makes it his biggest personal investment at that point. So what did he see? This company seems like it's on its last legs, and he's going all in. What was he thinking?
This goes back to his focus on the balance sheet.
Again.
Oh, yeah. He might have barely glanced at the income statement, the profit and loss stuff. That was probably a disaster.
Right, with all those losses.
Exactly. But the balance sheet, that's where he saw potential. They had a lot of inventory, worth something for sure. But get this. He also spotted what's called an off-balance sheet asset.
Off-balance sheet, so it's not even listed.
Right. These were their comb banks.
Comb banks.
Yeah.
Sounds pleasant.
Not really. It's basically the waste from the coal mining.
Oh.
Yeah, but here's the thing. Comb can still be burned as a low-grade fuel. It has value. And Buffett figured these comb banks alone, just those piles of waste, were worth about $8 a share.
Wow.
Add that to the inventory, and he figured the shares were worth at least $17.
So buying them at $9.
Huge discount.
Yeah. Even in a situation like this where you're looking at a struggling company, he's finding hidden value.
It's a crucial lesson. It's not just about finding cheap assets. It's about figuring out how to unlock that hidden value.
But hold on. Wasn't he also relying on his mentor, Ben Graham, in this situation? Graham's firm had invested too, right?
They had, yeah, Graham Newman. And Graham himself, he was on P&R's board of directors.
So maybe Buffett was just like trusting his mentor's judgment.
I'm sure that played a part. But Buffett did his own homework too, It wasn't blind faith. He saw the value in those calm banks, even if no one else did.
So what happened? This company, they were losing money, right?
Big time. In 1955, they reported a loss of over $7 million.
$7 million?
Yeah. That's when Graham Newman, they stepped in, used their influence to get control of the board. Got 5 seats.
Wow.
Then they did something really interesting. Instead of trying to save the coal business, they decided to liquidate the mining assets and use that cash to buy profitable businesses in completely different industries.
Wait, so they completely changed the company's direction?
100%. Total turnaround.
Amazing.
Their first major acquisition was Union Underwear.
Union Underwear.
Yeah, the company that made Fruit of the Loom. Paid $15 million for it. Huge chunk of P&R's assets at that time. Then they went on to buy Acme Boots, Lone Star Steel.
It's like they were building a whole new company.
Exactly. They transformed that failing coal operation into this diversified holding company. And here's the smart part. They used P&R's existing tax losses, what are called carry forwards, to shield the profits from those new businesses from taxes. Brilliant, really.
So they're using the bad stuff, the losses, from the old business to make the new businesses even more profitable.
Precisely.
Wow.
And remember those shares Buffett bought for $19? They ended up going above $65 a share.
Huge win.
Right. But I think the real takeaway here, the thing that's really important for you to grasp, is that this experience probably opened Buffett's eyes to a new way of investing. It wasn't just about finding undervalued companies anymore. It was about understanding that sometimes you need to be more active, Get involved in the company, make strategic decisions to really unlock that value. It's a more hands-on approach.
It's not just about buying and holding. It's about being strategic and maybe even a little bit, aggressive.
Yeah, maybe. P&R showed him that sometimes that's what it takes to win big.
Okay, let's shift gears to BC Power in the early 60s. Now, this one might seem a little strange after all that talk about diversification, Buffett actually put a big chunk of his partnership's capital into this one single opportunity in British Columbia. What was so special about BC Power?
Well, it was a pretty unique situation.
Okay.
The Canadian government, they decided to take over BC Power's main asset, this company called BC Electric Company.
Government takeover. That sounds messy.
It was. And BC Power, they weren't too happy with the price the government offered, so they sued for more money.
So there's a legal battle going on.
Right, and all that uncertainty, it tanked BC Power's stock price.
Makes sense. People get nervous when the government gets involved.
Exactly. But Buffett, he saw this as a classic workout investment.
Workout investment? What's that?
It means that the potential profit isn't tied to the company's normal business, you know, how much money they make selling electricity or whatever.
Okay.
It's about the outcome of this specific event, this government takeover, the lawsuit, all that.
So it's not about the long-term prospects of BC Power, but about how this whole legal mess plays out.
Exactly.
So what made him so sure he'd make money on this? I mean, it sounds pretty risky.
He did his homework, as always. First, he looked at the chances of BC Power getting a better deal from the government.
Okay.
The government had already seized the assets, which meant they were committed to paying something.
So some payment was pretty much guaranteed.
Right. And then there were these strong hints that BC Power was planning to just liquidate, you know, sell everything off once they got the money from the government.
So they weren't planning on continuing the business.
Nope. They'd already given a bunch of cash back to shareholders, which made it pretty clear they were winding things down.
Okay.
Third, the downside, the potential for loss, it seemed pretty small. The stock price was hovering around 38 Canadian dollars, not much higher than it was right after the takeover was announced.
So it had already taken a hit.
Exactly, and it was way below its previous high.
So limited downside, potential for a bigger payout.
Right. And don't forget, BC Power, they were a utility company. People always need electricity, so there's some inherent value there, even in a weird situation like this.
That's true.
And last but not least, Buffett knew other smart investors, arbitrageurs, they'd be looking at this too.
So he wasn't the only one who saw the opportunity.
Nope. And those other investors, they'd help to keep the stock price from falling too far. Less risk for Buffett.
So high chance of a good outcome, low risk of a bad one.
It sounds like a classic Buffett bet.
It was. And you know what? It worked. In 1963, the court ruled in favor of BC Power. They got an extra 20 million Canadian dollars, the government paid up, BC Power liquidated, and everyone who bet on Buffett's analysis made a nice profit.
Sweet.
And here's another cool thing about workout situations like this. Their returns aren't usually tied to how the stock market's doing overall.
So it doesn't matter if the market is up or down.
Exactly. Even in 1962, when the market was kind of flat, Buffett's workout investments, thanks largely to BC Power, made over 14%.
Wow.
It shows you that sometimes the best opportunities are in those unusual situations that most people wouldn't even look at twice.
It's about thinking differently.
Exactly.
Okay, let's move on to American Express. Mid-1960s. They're doing great. The credit card, huge hit. Revenues are soaring. Everything's coming up roses, and then boom, the salad oil scandal.
Salad oil scandal. What in the world is that?
It sounds like something out of a financial crime movie or something. It kind of is. So there was this company, Allied Crude Vegetable Oil Company. They were pulling off a massive scam.
Okay.
They had these huge storage tanks, supposedly full of salad oil. Banks gave them loans, tons of money based on these receipts saying they had all this oil. But guess what?
They were empty.
Mostly. Just a thin layer of oil on top of a whole lot of water.
Oh, no.
Yeah. And American Express, their field warehousing division, they had basically certified that the oil was there.
So they were vouching for a fraud.
Without knowing it, yeah. So when the whole thing blew up, American Express was potentially on the hook for millions, maybe even hundreds of millions of dollars.
That's a disaster.
Total disaster. And the market panicked, of course. American Express stock price plummeted. Nobody knew how bad the damage was going to be.
So what did Buffett do?
You know, he did what he always did. He took a deep breath and investigated. He didn't just freak out like everyone else.
Smart.
Right. At first, people thought American Express could be liable for like $135 million.
Wow.
Yeah, huge. Eventually, that number came down a bit, but it was still a massive potential hit.
So in a situation like that, what's the lesson? What should you be looking for?
You have to look beyond the immediate crisis, the numbers. You have to understand the value of a brand, its reputation. Because a strong brand, it can bounce back from almost anything.
So it's not just about the financial damage. It's about how much the public still trusts the company.
Exactly.
So in this case, everyone else was looking at those potential losses, how much money American Express was going to lose. But Buffett, he focused on something else, right?
He did. He focused on the fact that American Express was more than just a company. Their brand name was synonymous with trust. Think about it. Their whole business, traveler's checks, credit cards, it's all about people trusting them with their money.
Makes sense.
So Buffett's big question wasn't how much money they were going to lose. It was whether this scandal would permanently damage that trust.
And how do you even figure that out?
Well, he did his own research.
Like a detective.
Kind of, yeah. He went out and talked to people, restaurant owners, hotel clerks, bank tellers, people using their American Express cards.
Smart.
And you know what he found?
What?
Most people weren't that bothered by the scandal.
They still trusted American Express.
They did.
Yeah.
And it wasn't just anecdotal. The numbers backed it up. Sales of travelers' checks, way up. And even after the scandal broke, credit card billings kept growing. People were still using their cards.
So the business was still doing well, despite all the bad news.
Exactly. The brand, that trust, it was still strong. And that's when Buffett went all in. He bought a ton of American Express stock.
And he made a killing, right?
Oh, yeah. One of his most profitable investments ever.
So what's the big lesson here?
Sometimes a crisis creates an opportunity. If the fundamentals of the business are strong and the brand is solid, a temporary setback can be a chance to buy low and then ride the recovery.
Awesome. All right, last but not least, let's talk about Walt Disney. This is 1966. Mary Poppins had just become this massive global hit, super successful. But Buffett thought the company was incredibly undervalued. He famously called it, get ready for this, a supercalifragilisticexpialidocious investment decision.
Yeah, he's got a flair for the dramatic, doesn't he?
He does. But seriously, you've got this wildly successful company, a blockbuster movie, and yet the stock market's not really reflecting that success. What gives?
Well, back then, movie studios had a reputation for being risky investments.
Okay.
A big hit could be followed by a string of flops, It was unpredictable.
Makes sense.
And on top of that, there was Walt Disney himself, a creative genius, no doubt, but he also had this reputation for, putting his artistic vision ahead of everything else.
Even profits.
Sometimes, yeah. So some investors saw him as a bit of a wild card. They weren't sure if he was always making the best decisions for the company's bottom line.
So there's this uncertainty hanging over Disney.
Mm-hmm.
But Buffett, he didn't let that scare him off. He saw something else, right?
He did. He looked beyond those surface-level concerns. He saw the power of the Disney brand, the fact that it wasn't just about movies.
They had Disneyland.
Right,
Yeah.
exactly. They had theme parks, merchandise, all sorts of ways to make money from their characters and stories. They were pioneers in creating what we call intellectual property.
Right. Like they weren't just making movies, they were building a whole world, a brand.
Exactly. And they were brilliant at monetizing that world.
So he saw the bigger picture.
He did. And, he didn't just sit in his office and look at the numbers.
What did he do?
He went to see Mary Poppins.
He did.
He did. Not as an investor, but as a member of the audience. He wanted to experience the magic firsthand. And you know what he realized?
What?
Mary Poppins wasn't just a hit, it was timeless. It would resonate with audiences for generations to come. He famously said it was like an oil well that would never run dry.
Amazing analogy.
Isn't it? And then he actually got a personal tour of the Disney studio in Burbank from Walt Disney himself.
Wow.
During that tour, he learned about the new Pirates of the Caribbean ride they were building at Disneyland, and they told him how much it was going to cost, how much it was expected to be worth.
Okay.
And Buffett did the math in his head. He realized that the entire market value of Disney, the price of all the stock combined, was barely more than the value of Disneyland and this one new ride.
So all the other stuff, all those characters, the movies, all that intellectual property, it was basically being given away for free.
Pretty much.
Unbelievable.
So what's the lesson here? Sometimes the market just doesn't see the full value of a company. If you can look past the short-term noise and identify those truly exceptional brands, the ones with long-term potential, there's money to be made.
Sounds like a classic Buffett move.
It is.
So he buys a bunch of Disney stock,
yeah,
but there's a twist, right?
there is. Buffett, for whatever reason, he sold his shares a year later. Yeah, he made a profit, but it was nothing compared to what he would have made if he'd just held on. Those shares he bought for pennies on the dollar, just a few decades later, they were worth a fortune.
That's got to hurt. Missing out on all that potential profit.
It's a reminder that even the best investors make mistakes sometimes.
Yeah, even Buffett. But even though he sold too early, the initial investment itself, that was a great example of seeing the value that the market was missing.
Absolutely.
So let's take a step back and look at these 5 early investments. Grief Bros, P&R, BC Power, American Express, and Walt Disney. What are the big lessons we can take away from how Buffett approached these opportunities, especially early on in his career?
Well, there are a few key themes that run through all of them, and they're really revealing. First, he was willing to concentrate his investments.
Okay.
A lot of people will tell you to diversify, spread your money around. But Buffett, when he saw a really compelling opportunity, he wasn't afraid to go all in.
Believes in his own analysis, that's for sure.
Exactly. And second, remember P&R, that showed him that sometimes just buying a stock and waiting isn't enough.
Right.
Sometimes you have to get involved, shake things up, make strategic decisions to unlock that hidden value.
A more active approach.
Right. And finally, all these investments, they highlight how important it is to do your own research.
Don't just trust the headlines. Right?
Exactly. Buffett, he dug into the balance sheets, he looked for hidden assets, he talked to customers, he even went to see the movies. He wasn't just crunching numbers, he was getting a deep understanding of the businesses he was investing in.
It's like he was a detective piecing together the whole story.
That's a great way to put it. And, all those early successes and even those missed opportunities like Disney, they shaped him into the investor he is today. He learned to think differently, to see the value that everyone else was missing.
It's an inspiring story, really. It shows that with the right mindset and the willingness to put in the work, anyone can learn to invest like Buffett. So, as we wrap up this deep dive, I think the big question for all of us is this. What overlooked opportunities are out there right now, just waiting for someone to come along and see them?
There's got to be tons.
What if we all started thinking a little more like Buffett, What if we started looking beyond the obvious and digging deeper, doing our own research and trusting our own judgment? Who knows what we might find?
I like the way you think.
Thanks. I think that's something worth thinking about.
Definitely.
That's it for our deep dive today. See you next time.
See you then.